because when the yen got too expensive, that created a panic. But if the dollar gets too expensive, we're talking about a bigger banking crisis, in my mind, than 2008.
You're watching Silver News Daily. Subscribe for more.
Could the collapse of the U.S. dollar make silver the most valuable asset of our time? It sounds far-fetched, but with global financial instability and the rise in currencies around the world teetering on the brink, silver might just be the safest bet. Today, we're diving into why experts believe silver could be the last refuge in a collapsing economy. So stick around, because this could change everything you think you know about your financial future.
And you had a terrible Monday and a wonderful Tuesday, because in '87, Greenspan immediately said we're going to cut rates. And in this case, Japan says we're going to walk back that little rate hike. So there was a pause and a sigh of relief, and there was this huge crash and then rebound. But that really is short-sighted if you think that's a solution, because what the Japanese carry trade showed us is just how thirsty for oil the global engine is, how little liquidity there is. And the Japanese carry trade, I think you're absolutely right, though, Dunnigan, because this derivative market and the derivative thinking, or the lack of derivative thinking, but the risks in the $1 trillion+ derivative market outside of the U.S. markets is, I think, the bigger carry trade. Because when the yen got too expensive, that created a panic. But if the dollar gets too expensive, we're talking about a bigger banking crisis, in my mind, than 2008. And I'll explain that, because in 2008, your viewers remember the too big to fail banks over their skis and debt and leverage with mortgage-backed securities and toxic real estate assets bundled together and tranched together. And those unwound, and we had a liquidity crisis in 2008 through the U.S. banks, the great too big to fail, smartest guys in the room banks. What many people need to understand is there is a whole other banking system outside of Wall Street, and that's like Credit Suisse or HSBC or Dresdner Bank or Deutsche Bank or UBS. It's called the Eurodollar trade. But Eurodollar just means any dollars being traded outside of the U.S. It could be anywhere in the world. It doesn't necessarily mean with U.S. banks. But the derivative markets in Europe, they're playing the derivative markets too. They need U.S. treasuries as collateral. And unlike U.S. banks, they can't go to the Fed and get that collateral, those T-bills or bonds on the cheap. They have to bid for them. So they need dollars. So if the dollar gets too strong, then Eurodollar banks like Credit Suisse or Deutsche Bank, et cetera, the big banks overseas where I'm at, from my perspective, well, they're in trouble. Then they have to either delever or default in their derivative books. And that could create an unwinding, which is far greater than we just saw in 2008 or certainly on August 5th. And I think the carry trade of the yen being too strong for the markets to swallow, well, that's certainly a true headline. But the hidden headline, the hidden shark fins beneath these very debt-driven, bloodied waters is a carry trade in the U.S. dollar. It is the world reserve currency. It is expensive. When it becomes too expensive, or if we stay higher for longer under the Powell policy, that puts a tremendous amount of pressure on the balance sheets of non-U.S. banks that still trade in U.S. dollars and need U.S. treasuries. So again, the Japanese carry trade, the U.S. Eurodollar carry trade, these are all different examples of potential.
The global financial system is more fragile today than at any point in recent history, teetering on the edge of a potential collapse that could fundamentally alter the economic landscape as we know it. Central banks worldwide are grappling with unprecedented levels of debt, inflation is soaring beyond control, and geopolitical tensions are pushing the global economy towards a breaking point. At the heart of this turmoil lies the U.S. dollar, a currency that has dominated global trade and finance for decades, but is now showing alarming signs of weakness. To understand the gravity of the situation, we need to delve into the underlying factors that are driving this instability. Matthew Peitberg, a respected voice in economic analysis, has consistently warned of the systemic risks that have been building within the global financial system. According to Peitberg, the dollar's dominance is not only being challenged by the rise of alternative currencies, like the Chinese yuan, but also by the growing discontent among global powers with the U.S. economic policies. The aggressive use of sanctions, the reckless printing of money, and the increasing reliance on debt to fuel economic growth have all contributed to a loss of confidence in the dollar. What we are witnessing is a confluence of crises that could trigger a domino effect, leading to the rapid devaluation of the U.S. dollar. Peitberg and other experts suggest that the dollar's weakening grip on global trade is a sign of deeper problems that are not easily reversible, as inflation erodes the purchasing power of fiat currencies, and the U.S. struggles to maintain its fiscal discipline. The dollar's status as the world's reserve currency is under threat. This looming financial storm is prompting investors in nations alike to seek alternatives to the dollar. Precious metals, particularly silver, have historically served as safe havens in times of economic uncertainty.
Wall Street and the world markets are making the assumption that you could use Japan as a prop desk to get leverage or arbitrage and leverage rates and currencies. So you could borrow in yen, lever that, and buy stocks on the S&P, pretty much tech stocks primarily. So you could use much lower interest rates in Japan to do a carry trade in the Western markets or Australian markets, primarily the U.S. markets. And that was a very good play as long as two assumptions were always true, that the yen would stay low, that rates would stay low, and that tech would stay high. And what happened last week, of course, was an unwinding of that. Japan's central bank raised their interest rates by 15 bips in August and then they had done a smaller rate hike as well in March. But the combination of that very small rate hike just upset the table for that whole carry trade. And we saw what happened. Two largest Japanese banks lost 10 or 11 to 15% overnight. The Japanese yen went up 10%. We saw the Nikkei 225 lose its greatest, over 4,500 points, the worst loss in its history, just one day. The Nikkei futures tanked, Bitcoin tanked, like a tech stock, like a levered tech stock, AI semis tanked. So we saw this ripple effect in global markets from what happened with a small interest rate hike in Japan. I think the larger story is bigger than the carry trade. You were hinting at this. This is really, as I've said many times, a global debt balloon approaching, 350 trillion to 400 trillion in the next 5 to 10 years is going to go to 400. But you've got a global debt balloon with so many needles pointing at it, and those needles all affect liquidity. And liquidity, anyone familiar, and your viewers, I'm sure, anyone familiar with markets, every market crash is a liquidity crisis. At the end of the day, there's not enough oil in the engine, and the engine starts to smoke and hiss and pull over and crash on the side of the road. And what we saw in a lot of ways, we talk about liquidity through quantitative easing or money printing, or there's backdoor, I call it backdoor QE through supplementary leverage ratios, or the repo markets, the reverse repo markets, or the BTFP program, or Freddie Mac offering more leverage, or these mechanizations, the Treasury General account. We're always looking for liquidity to keep this broken car running, to keep a little more oil in the engine. Obviously, direct QE is certainly liquidity. In a lot of ways, Japan was a source of liquidity for the markets. And when they raised rates, what would seem an infinitesimal amount, 15 basis points, that was enough to send the markets into a panic. And then, of course, the next day, like in 87, when we had a crisis, the flash crash, like 87.
Silver, with its dual role as a store of value and an industrial metal, offers a unique hedge against the collapse of paper currencies. Unlike fiat money, which can be printed at will, silver's value is intrinsic, rooted in its scarcity and demand across various industries. As we stand on the precipice of what could be a monumental shift in the global financial order, the question arises, what happens if the dollar collapses? Will silver emerge as the go-to asset for preserving wealth? The signs are increasingly pointing in that direction. The long-term bullish trends in silver, supported by growing investor sentiment and the potential for geopolitical upheaval, suggest that silver could become a critical asset in a new financial paradigm that might follow the dollar's decline. Heitberg and other financial analysts are raising the alarm, urging individuals to consider the implications of a world where the dollar is no longer king. The erosion of trust in the dollar is not just a theoretical concern. It is a reality that is unfolding before our eyes, with potentially catastrophic consequences for those unprepared. In this volatile environment, silver stands out not only as a safe haven but also as a strategic investment that could safeguard against the worst outcomes of a global financial collapse. As we continue to explore this topic, we will look deeper into the factors that are driving silver's potential rise and how you can position yourself to benefit from this.
That's stupid, but they're always late. They're always behind the curve. I'm not alone in saying that. I'd hate to be in their position. By the way, I'd hate to be either Harris or Trump, and whoever's going to be in the White House in the next year. Because someone joked the other day, I think it was a brilliant analogy. I wouldn't want to be the captain of the Titanic after we hit the iceberg. because there's no solution now in the next 4 years, whoever is in there. And I've been very flippant by saying it could be Santa Claus or Papa Smurf or Albert Einstein or, Nobel Prize economist. We can't fix this in 4 years, no matter what, whether we stay higher for longer, whether we raise rates or lower rates. We can have a very disinflationary recession or a very deflationary market correction, mean reversion, but we're going to ultimately have to create so much synthetic liquidity, in other words, mouse click money, to support our bond market and keep rates controlled and keep markets from completely tanking. And that, unfortunately, it's inflate or die. And we can still have a very disinflationary moment, but the end game will be, I call it, QE to the moon. I don't see any other way around that. Some people have argued, well, the other way around that is some global reset or global war. And again, I guess that's true. Those are possibilities. I don't know how we'll do a global reset when the G7 doesn't get along with the BRICS nations, and the East and the West are now very divided. There are possibilities, but I think we'll save the quote unquote system at the expense of the currency. And of course, that is a direct bridge into conversation on gold that we've been having for years. And so far, without being pompous, we've been right about the dollar. The de-dollarization themes, the devaluation of the dollar, the debasement of the dollar necessary to cover unsustainable debts. And the conversation, of course, then goes to gold, which is now a tier one asset under the BIS right here in Switzerland. It's a tier one asset next to the U.S. Treasury because it holds its value better than a U.S. Treasury. And so even the BIS has admitted, then again, what you and I and everyone else have been talking about for years, this dollar is unsustainable and this debt is unsustainable. And the only way out of it is to debase it, as every country throughout history, every empire, nation, monarchy, democracy, oligarchy has done at every turning point at the end of a cycle of an empire or nation. They debase their currency to inflate their way out of debt.
While the U.S. dollar continues to dominate global transactions, a growing number of investors and nations are quietly shifting their focus to silver as a potential safe haven. But why silver? The answer lies in its unique position within the financial ecosystem. Silver is not just a precious metal, it also plays a critical role in industries ranging from electronics to renewable energy. This dual nature of silver makes it a highly sought-after asset, particularly in times of economic uncertainty. Historically, silver has been a trusted store of value during periods of financial turmoil, and its role as a hedge against inflation cannot be overstated. As central banks around the world continue to print money to address economic challenges, the value of fiat currencies, including the dollar, is becoming increasingly unstable. Investors are beginning to recognize the need to diversify their portfolios with assets that can withstand the devaluation of paper money. Silver, with its intrinsic value and limited supply, is emerging as a compelling choice. Moreover, silver's accessibility compared to gold makes it an attractive option for a broader range of investors. While gold has long been considered the ultimate safe haven, silver offers similar protective qualities, but at a fraction of the cost. This affordability factor, combined with silver's historical performance in times of crisis, is driving a surge in demand. Investors are not just looking at silver as a speculative asset, they're seeing it as a critical component of a resilient investment strategy.
Ironically, is inherently inflationary. That's the fiscal dominance argument. And what Harris and Trump and Yellen and Jake Sullivan are saying, and many others are saying, look, we're not going to beat inflation. Powell has a human, all too human ego who doesn't want to be the next Arthur Burns or doesn't want to be the guy who couldn't beat inflation. He wants to get to 2% inflation by killing demand, by crushing the consumer, by basically raising rates so high that our bankruptcies, business bankruptcies, are up to all 13-year highs, 35% higher than last year. Small businesses, the middle class, are getting crushed because he's crushing demand to create deflation, to fight inflation. Well, thank you very much for that solution if you're an average citizen in America, because that's crushing you. Higher costs of debt, a devalued dollar, higher inflation, higher interest rates. That's the perfect storm for people living month to month, week to week. And so that's how the inflation in Wall Street has not affected the middle class or the working poor, and they're getting crushed by a double whammy. So if we can allow inflation to rip, in other words, admit that we've lost the war on inflation, Powell will have to admit that, and he'll start reducing rates. My theory is he won't do that until we have a banking crisis or a market crisis, and he won't do it for political reasons. But I could be wrong on that. But we have to reduce our interest rates simply because the bond market, Main Street, and most importantly, Uncle Sam can't afford Powell's policies. What they've been doing, though, even though at these 5.75% rates and staying where they are, our inflation rate, according to Shadow Stats and certainly Larry Summers, is anywhere between 11 and 15%. It's also very important to remember that the CPI scale and all the tricks they use, the CPI scale is a rate of change, not a price level change. So when we were at 9% and 6% and 4%, that's compounding. That means in the last many years, you've been losing compounding purchasing power on your dollar significantly. Some have said 30% in the last 5 years. So if that's true, if you're making 20% even and you're lucky on the S&P or in NVIDIA or something, you're still losing to actual inflation, that invisible tax that nobody at the Bureau of Labor Statistics or Washington, D.C. want to admit. So as Claude Juncker said, the head of the European Commission, well, we don't like the facts, we lie. I know that sounds dramatic. We're lying about inflation. We're misreporting inflation. And we're saying we're fighting inflation. But as Harris and Trump both, if they're confessing we need to cut rates, that means we can't beat inflation. We're going to have to allow inflation. We'll still misreport it, but we're admitting we've lost the war on inflation. And I think Powell's having a hard time admitting that because the Fed, they're
The geopolitical landscape is also playing a significant role in silver's rising appeal. As tensions escalate between global superpowers, the stability of traditional financial systems is being called into question. The ongoing de-dollarization efforts by BRICS nations and other emerging economies are further eroding confidence in the U.S. dollar, creating a fertile ground for alternative assets like silver to thrive. These nations are increasingly conducting trade in local currencies and exploring alternatives to the dollar, signaling a potential shift away from dollar dominance. As these trends gain momentum, silver's role as a hedge against currency devaluation is becoming more pronounced. The metal's industrial demand, particularly in emerging technologies such as solar panels and electric vehicles, is expected to continue growing, further strengthening its position in the global market. This industrial demand, coupled with its traditional role as a store of value, positions silver uniquely to benefit from both economic growth and financial instability. In the coming sections, we will delve deeper into these factors and explore how they could lead to a significant revaluation of silver in the near future. We'll also discuss the strategies that investors can employ to capitalize on this potential shift. But one thing is clear, as the world grapples with unprecedented economic challenges, silver is emerging not just as a hedge against risk, but as a cornerstone of financial security in a rapidly changing world.
And I agree. And I wish Jerome Powell would finally just admit it himself too, because even Janet Yellen and Jake Sullivan over at the Treasury have just unwound 40 years of strong dollar talk to just confessing we need a weaker dollar. We need negative real rates to inflate our way out of debt, to deal with this debt problem that we just discussed. And again, so I know not everyone in the audience, is into the wormy, wonky language of Wall Street. Negative real rates just means we need inflation to be higher than the yield on our 10-year or the yield on our bonds. And that really means you're basically getting no return then on your bonds. So you're admitting defeat. What Jerome Powell wants to do is have his cake and eat it too. He knows we need higher inflation to inflate our way out of debt. He knows we need negative real rates. What the BIS and the Fed do, and I'll say it and I'll say it openly, is they'll just lie about inflation. And again, this is not Matt Peipenberg on a soapbox. This is John Williams. This is even Larry Summers, the former Treasury Secretary. We all know that the official CPI number is just dishonest. It's whatever the Fed says it is, so it's never right, but it's always correct. But we've been trying to play this game by misreporting inflation. But now, when you've got Yellen, or Jake Sullivan or Trump or Harris admitting that we need a weaker dollar. And this is what I've been arguing with Brent Johnson. We can't afford a stronger dollar. The DXY can't go to 150 because it hurts us more than anyone else. But it hurts us also if we have a weaker dollar because, to your point, if we're going to weaken the dollar, it means we're going to have to lower rates at some point. We will. And I don't know when. Everyone's talking. I said in January, it'd probably be September. We'll see. Thomas Hernig at the Fed says, a former Fed FOMC, who was the president of Kansas City Fed, said that'll happen when we have a banking crisis. And we can talk about banking risk, but we will have to lower rates for one very simple reason. Not just all the inflation discussions. It's very simple. Our interest expense on our Uncle Sam's IOU, on our bar tab for spending beyond our means, is going to be 1.7 trillion into 2025. We simply do not have that money. That's our biggest budget outlay right now. And we don't get that through tax receipts and GDP. If we go higher for longer to fight inflation, to Powell's point, stay with higher for longer, we can't afford our own interest expense without creating more money out of thin air to pay our interest expense. So his war on inflation through higher for longer.
As we navigate through these turbulent economic times, one of the most pressing concerns is the impact of escalating geopolitical tensions on global currencies, particularly the U.S. dollar. The U.S. dollar has long been considered the backbone of global trade and finance, but recent developments are beginning to shake this foundation. Geopolitical tensions, especially those involving major powers like the United States, China, and Russia, are creating ripples across the global economy that could have profound implications for the future of the dollar. These tensions are not just political, they're deeply economic. Sanctions, trade wars, and strategic alliances are increasingly being used as tools of economic warfare, with significant consequences for global financial stability. For example, the U.S. has employed economic sanctions as a primary weapon against countries like Russia and Iran, cutting them off from the dollar-based financial system. While these measures aim to exert pressure on these nations, they also push them and their trading partners to explore alternatives to the dollar. This growing move towards de-dollarization is particularly evident in the actions of the BRICS nations: Brazil, Russia, India, China, and South Africa. These countries are actively seeking to reduce their dependence on the U.S. dollar by increasing trade in local currencies and developing financial systems that bypass the traditional dollar-based infrastructure. The expansion of BRICS to include countries like Saudi Arabia and the UAE, which are major global players in oil and gas, further underscores this trend.
Needles to hit this debt bubble. And I don't think you can underestimate that. It's no longer gloom and doom sensational anymore. We're seeing this. And I always have to remind, I'll pause after this, we have to think of these debt numbers without just glossing over them as abstractions. I was born when we went off the dollar standard. And that's in my short lifetime. I'm not that old yet. I'm getting older. I'm not that old. But in 1971, our debt to GDP was 38%. Today, it's over 122%. When we went off the gold standard, we had $246 billion in public government debt. Today, we have over $35 trillion. These things are extraordinary in the scope and pace and range of that type of debt growth. And so when you're looking at that kind of debt growth, we went from 17 trillion to 34 trillion in just a decade. It took us 220 years to get our first 11 trillion in public debt. And just in the last 4 years, we've done another 11 trillion. We have $3 trillion twin deficits, and we have 190 trillion in assets and 210 trillion in liabilities. So again, sounds like I'm whipping out stats, but think very carefully about those numbers. These are abstractions to many people. Trillions mean nothing, but these are unsustainable debt levels, which means we have liquidity needs to cover that debt. When that liquidity dries up, and unless we create or fabricate more artificial liquidity, because we're not getting that from GDP, we're not getting that from tax receipts, we're not getting that from manufacturing, which we've outsourced overseas. The American dream, as I said, is now made in China. So if we're not going to get that liquidity naturally through growth and through productivity, we're going to have to fabricate liquidity, which means we're going to have to debase our currency. But again, we can always have liquidity, but there'll always be a loser. The loser will be the dollar, the peso, the yen, the Swiss franc, the euro, the yuan that you measure your wealth by. So this liquidity crisis is real. The debt crisis is real. The derivative euro dollar carry trade US dollar thing is real. And which of these needles, which will cause this liquidity problem and popping of this debt bubble is really impossible to foresee. It's usually not the thing you see coming. Although I warned many people, not me, have warned about the Japanese carry trade unwinding for the last 12 months. But it's fun until it's no fun.
The decline in the dollar's influence is not happening in isolation. It is part of a broader shift in the global balance of power, where emerging economies are asserting greater control over their financial destinies. This shift is creating a more multipolar world, where the dominance of any single currency is less assured. As these geopolitical dynamics unfold, they are likely to accelerate the dollar's decline, with significant implications for global financial markets. For investors, This geopolitical instability translates into increased risk in holding dollar-denominated assets. As confidence in the dollar wanes, there is a growing interest in assets that are less susceptible to geopolitical influences, like silver. Silver, with its intrinsic value and its role as both a precious metal and an industrial commodity, offers a refuge from the uncertainty that is gripping the global financial system. It is seen as a hedge not just against inflation, but against the broader economic and political risks that are increasingly threatening the stability of the dollar. The effects of these geopolitical tensions are already being felt in global markets. We are witnessing increased volatility in currency markets, with the dollar facing downward pressure as countries diversify their reserves. This diversification includes not just other fiat currencies, but also tangible assets like gold and silver. As the dollar's dominance is increasingly challenged, silver's appeal as a stable, reliable asset is growing. In the next section, we will explore how the Federal Reserve's policies may further destabilize the dollar, setting the stage for silver's rise. We'll examine how central bank actions, particularly interest rate cuts, could weaken the dollar's value and drive investors towards silver as a safer alternative. But for now, it's clear that the geopolitical landscape is tilting in favor of silver as nations and investors alike seek shelter from the brewing storm.
Basements doing Google searches, they're not crazy. That's pretty sensational for me. I hope that's wrong. But we all, when I walk through the streets of America, we see how different Venice Beach is, or South Chicago, or Philly, or Minneapolis. We see it. We see it, and we see in the suburbs, we see what meth has done, or fentanyl. So it's a different, sad, tragic world. And all of this, though, is tied to debt. All this is tied to currencies and central banks. It's hard to believe. It's certainly political. But it's a sin to live beyond your means at such a level and then blame it on something else other than your own policies, and then make the middle class suffer the theft, and then call that, through misreported inflation, the fault of COVID or Putin or global warming, when it's just politicians buying time through easy money and taking our debt. Again, remember what I said earlier. In 1971, before we decoupled from that golden chaperone, we had $246 billion in government debt. But now that we can print as much money as we want, we have 35 trillion. 35 trillion 50 years later. From less than 1 trillion to 35 trillion in my lifetime. That is an important thing to reflect on. That what would that do to a family, a business, a government, or an individual who had that much more debt than income? You could live off Visa, MasterCard, and Amex flipping around, but eventually you're going to pay the piper, or you can steal from somebody else and blame your problems on bad parenting or unfair world. But the reality is because you're living beyond your means. And as a government, our public officials who are supposed to be serving the public are self-serving themselves, getting reelected, even Nobel Prizes in Bernanke's case, by solving a debt crisis with more debt, paid for with money literally mouse clicks out of thin air, and then dumping the inflation on the citizen who feels nothing but resentment right now. And now they're fighting among themselves on every issue under the sun. But the real problem, sadly, despite all the other things, is at ground like it's economic. Grundsätzlich, as we say in Switzerland, it's fundamentally an economic problem. And history moves on philosophy, it moves on human nature, but primarily it moves on when you haven't had a meal in 3 days, or you can't afford your kids' tuition and you're stressed out. It breaks up families, it breaks up societies, it breaks up government.
The role of the Federal Reserve in shaping the future of the U.S. dollar, and by extension, the global economy, cannot be overstated. As the central bank of the United States, the Federal Reserve's decisions on monetary policy have far-reaching consequences, not just for the U.S. economy, but for the entire world. In recent years, the Fed has implemented a series of aggressive policies aimed at stabilizing the economy, particularly in the wake of the 2008 financial crisis and the economic disruptions caused by the COVID-19 pandemic. However, these policies, particularly the prolonged low interest rates and extensive quantitative easing programs, have sown the seeds for potential long-term instability. The most immediate concern is the Federal Reserve's approach to interest rates. Historically, higher interest rates have attracted foreign investment into U.S. dollars, strengthening the currency. However, the Fed's recent stance suggests a potential shift towards rate cuts in response to slowing economic growth and fears of a recession. This move is intended to stimulate the economy by making borrowing cheaper, but it comes with significant risks. Lower interest rates weaken the dollar by reducing the returns on dollar-denominated investments, making them less attractive to global investors. Matthew Peitberg, a prominent economic analyst, has emphasized the precarious nature of this strategy. According to Peitberg, while rate cuts may provide short-term relief, they undermine the long-term value of the dollar. This is particularly concerning in an environment where inflation is already a significant issue. With more dollars in circulation and lower returns on investments, the purchasing power of the dollar is likely to decline, leading to a potential loss of confidence in the currency. The implications of this are profound. As the value of the dollar diminishes, it becomes less viable as a global reserve currency. Countries that have long relied on the dollar for trade and reserves may begin to seek alternatives, further eroding the dollar's dominance. This is where silver enters the picture as a strong contender. Unlike fiat currencies, silver's value is not tied to the decisions of central banks or governments. Its value is intrinsic, based on its rarity, industrial demand, and historical role as a store of wealth. Moreover, the Federal Reserve's policies could inadvertently drive up the demand for silver. As investors lose confidence in the dollar, they are likely to turn to assets that can offer protection against currency devaluation. Silver, with its established history as a hedge against inflation and economic uncertainty, becomes an increasingly attractive option. The metal's lower entry point compared to gold makes it accessible to a broader range of investors, further boosting its appeal in times of financial instability. We are already seeing signs of this shift. The recent bullish trends in the silver market, despite short-term fluctuations, indicate growing interest in the metal as a safe haven asset. As the Federal Reserve continues to navigate the complexities of maintaining economic stability, the unintended consequence may be the acceleration of silver's rise as a preferred asset among investors wary of the dollar's future. In the next section, we will examine the historical performance of silver during economic crises and how these precedents could inform its future trajectory. But for now, it's clear that the Federal Reserve's policies, while aimed at supporting the economy, could be setting the stage for silver to emerge as a key player in a post-dollar financial landscape.
Which was really selfish and political. But what's more important, more interesting about Hernig is before he was the president of the FOMC or of the Kansas City Fed, he was a banking expert in the FDIC and he was a banking regulator. He understood banking risk. And he said right now, if you were looking at the U.S. banking system, I just mentioned the European banking system is highly vulnerable to the dollar carry trade and a rising dollar. But what he said is, American banks, we are just one crisis away, one banking crisis away from full-on QE to the moon, because the way he looks at banks, I mean, you've got 600 billion of these the too big to fail banks have over 600 billion in unrealized losses in their treasury holdings alone, just that. And then trillions more in other investments that are lost under the higher for longer policy, because the higher for longer policy has crushed a lot of commercial real estate loans. So we're looking at trillions of potential losses on our too big to fail banks that took us through this movie before in 2008, and yet they've gotten away with it for another generation, it almost seems. But he says, and he's a former president, and he is a former banking expert. So it's not a gold bug cynical guy out of Zurich saying this. He said it's nonsense how American banks are having this conversation about risk-weighted return. They've got 14% of risk-weighted capital on their books to protect them. He says the real ratio is capital to total assets, and that's about 7%. And in the banking world, that is extremely thin margin of error. So if we have any kind of real hiccup in the economy or in the markets, or even with rates, these banks are skating on, they're driving a bulldozer on very thin ice. And we know what will happen. A BTFP-like solution will happen because no politician, central banker, or commercial banker who's paid on share prices can allow a too big to fail system to collapse. They are too big to fail, but they're too stupid to succeed, because the only way to fix this problem is to create enough of that oil for the engine again. But that oil is getting thinner and thinner and whiter and whiter and wetter and wetter, and it has less and less purchasing power. And that will certainly affect the middle class the most. because they're going to get stolen from again and again. And again, whether you can.
Throughout history, silver has played a pivotal role during times of economic upheaval, often emerging as a reliable store of value when traditional financial systems falter. As we look back at past economic crises, a clear pattern emerges. Silver tends to shine brightest when the global economy is at its darkest. This historical precedent is particularly relevant today as the world faces growing uncertainty, and the stability of fiat currencies, especially the US dollar, is increasingly called into question. Let's start by examining some of the most significant financial downturns of the past century. During the Great Depression of the 1930s, for instance, while many assets plummeted in value, precious metals like silver retained their worth. Investors flocked to silver as a safe haven, a tangible asset that wasn't subject to the same risks as paper currency or stocks. This trend repeated during the economic turmoil of the 1970s, a decade marked by soaring inflation and the collapse of the Bretton Woods system. Silver prices surged as investors sought refuge from the rapidly devaluing dollar, driven by a mix of high inflation and geopolitical instability. More recently, during the 2008 financial crisis, silver once again demonstrated its value as a protective asset. As global stock markets crashed and the U.S. housing bubble burst, silver prices initially dipped but quickly rebounded, ultimately rising to historic highs in the years that followed. This was largely because silver, like gold, is perceived as a crisis commodity and asset that investors turn to when confidence in the broader financial system erodes. The 2008 crisis highlighted silver's role as a hedge against both inflation and deflation, showcasing its versatility in different economic scenarios. These historical examples are not just relics of the past. They provide valuable insights into silver's potential performance in future crises. As the current global financial system shows signs of strain, with escalating debt levels, geopolitical tensions, and the prospect of a weakened dollar, silver is once again being viewed as a safe harbor. The patterns from previous crises suggest that in the face of rising inflation or a potential collapse in the dollar's value, silver could see a significant surge in demand. Moreover, the industrial demand for silver adds another layer of resilience to its value. Unlike gold, which is primarily a monetary and investment asset, silver is also a critical component in various industries, from electronics to solar energy. This dual role means that even in the absence of a financial crisis, the demand for silver remains strong due to its essential industrial uses. This was evident during the COVID-19 pandemic, where despite economic disruptions, the demand for silver in industries like electronics and renewable energy continued to support its price. As we consider the current economic landscape, it is crucial to recognize that history often repeats itself. The conditions we are witnessing, widespread economic instability, weakening fiat currencies, and growing uncertainty, are strikingly similar to those that preceded past surges in silver prices. If the global economy continues on its current trajectory, the historical precedent suggests that silver could once again emerge as a top-performing asset, providing a hedge against the risks of a collapsing financial system. In the next section, we will explore how the ongoing de-dollarization efforts by global powers, particularly the BRICS nations, could further bolster silver's position as a key asset in the new financial order. But for now, it's clear that silver's historical resilience makes it a compelling choice for those looking to safeguard their wealth in these uncertain times.
Yeah. Yeah, Alistair is very, very wise in the inner mechanizations of the U.S. or global banking system, and I think there are a lot of parallels you can draw to that, the Roaring '20s in the current era, especially when you see a market driven like an S&P, which is a tech ETF, where 20% of its market cap is in 3 names, or a Nasdaq where 30% or 50% of its market cap is in 10 names. That's very familiar to this bacchanalia period of the Roaring '20s, where the markets peaked before they tanked, and then even after they tanked, they rebounded, and then they slowly really went overboard. You could see the similar parallels in the Nasdaq during the dot-com bubble. You could certainly see those parallels in '89 in Tokyo before the Nikkei crash. So there's a lot of parallels. To my prior point, theoretically, under modern monetary theory, you could say even if markets tank to a mean reversion of 80%, the Fed could just monetize and nationalize the markets by printing enough trillions to pop it back up. But again, that's at the expense of the purchasing power of your dollar. I think the conversation on banking risk, I mean, in 2023 wasn't that long ago. We had three of the four largest bank failures in America. We had Signature, SVB, First Republic, and then Credit Suisse, of course, imploded. That had to effectively be nationalized. 2024 with commercial real estate, I think it was Union, New York Community Bank. I mean, they had their non-performing loans were higher than their loss reserves. These were risks that, again, don't really make the headlines. That's the lie of omission under the current kind of media and political environment we live in. You don't know where to get your data. It's this be calm, carry on. So this banking risk, you could argue, is the pessimism of a sound money advocate out of Switzerland who has a very strong bias towards gold. But you can talk to even the old Fed. Again, I mentioned Thomas Hernig. I really admire him because he's one of the few FOMC officials who has integrity. And when he became president of the Kansas City Fed, his mentor said, Tom, when you come in here, make decisions for the long term and let the short term take care of itself. And what he has said is that his Fed, the one he vetoed every chance he could get from Bernanke on, has done just the opposite. They were thinking only short term, the next generation be damned, in a sense.
As we delve deeper into the shifting global financial landscape, one of the most significant developments to watch is the ongoing de-dollarization efforts led by the BRICS nations: Brazil, Russia, India, China, and South Africa. These emerging economic powerhouses are actively seeking to reduce their reliance on the U.S. dollar, a move that could have profound implications for global finance and, more specifically, for silver. The dollarization refers to the gradual process of countries moving away from using the U.S. dollar as the primary currency for international trade and financial transactions. This shift is driven by several factors, including the desire for greater economic sovereignty, the need to insulate their economies from U.S. sanctions, and the strategic goal of reshaping the global financial system to better reflect the economic realities of the 21st century. For the BRICS nations, which together represent a significant portion of the world's population and economic output, reducing dependency on the dollar is not just a financial strategy, but a geopolitical imperative. The expansion of the BRICS bloc, with the potential inclusion of other major economies like Saudi Arabia and the UAE, underscores the seriousness of this effort. These nations are among the world's largest producers of oil and gas, commodities traditionally traded in dollars. If they begin to price and trade these resources in alternative currencies, or even in a new BRICS currency, the implications for the dollar could be dire. Such a move would diminish the dollar's role as the world's reserve currency, leading to a significant shift in global economic power. For investors, the ramifications of de-dollarization are immense. As confidence in the dollar wanes, there is a growing need for alternative assets that can provide stability and security in a rapidly changing financial environment. Silver, with its historical role as a store of value and its current industrial demand, is perfectly positioned to benefit from this shift. As the dollar's dominance is challenged, the value of silver could rise, driven by increased demand from both investors and nations looking to diversify their reserves. Moreover, the BRICS nations are not just reducing their dollar exposure, they are actively increasing their holdings of gold and silver as part of a broader strategy to diversify their foreign exchange reserves. This trend is particularly pronounced in China and Russia, where its central banks have been steadily accumulating precious metals over the past decade. These purchases are not just about hedging against currency risk. They are also about preparing for a future where the dollar is no longer the linchpin of the global financial system. The creation of a BRICS currency, potentially backed by a basket of commodities including silver, could further accelerate this trend. Such a currency would offer a direct challenge to the dollar's supremacy, providing a stable alternative that is less susceptible to the political and economic fluctuations of any single country. In this new financial order, silver could play a crucial role, not just as a hedge against the decline of the dollar, but as a cornerstone of the new monetary system. As we witness these tectonic shifts in the global economy, it's becoming increasingly clear that silver is more than just a precious metal. It is a strategic asset with the potential to reshape the future of global finance. In the following section, we will explore the current market sentiment towards silver and how investors are positioning themselves to capitalize on these emerging trends. But for now, one thing is certain: that the dollarization efforts of the BRICS nations are setting the stage for silver to take on a much more prominent role in the global financial system.
Absolutely theft. It's absolutely theft. It's an invisible tax. But think about it, that's the invisible tax, the inflation, which is also misreported, which to me is devious. It's devious to misreport, to be dishonest, to not be transparent, to play around with core CPI, CPI, PCI, CPI, all these different names, but they're just not being honest about what the actual real inflation is. When you take on that invisible tax of misreported, underreported by 50% or more inflation, which is killing every dollar you save, and then you add your actual income tax onto that, that's real tax. And then you add on the additional hurdle of higher expenses. The average American's credit card interest rate is 22 or 23%. That's not devious, that's immoral. So the cost of debt is higher, the value of your currency is weaker, the inflation is taking more from you, and then there's your actual tax bill. All of that together means you are barely able to move as your legs are moving forward. You're not going anywhere. As I say, running uphill in roller skates. Again, this is not sensational. Now, if you're in the top 1% or the top 10%, that's annoying. If you're in that completely ignored middle class, which was decimated by the Fed, in my opinion, and they had the audacity to say that monetary policy at the Fed doesn't affect social classes, that's simply empirically untrue. It's the biggest wealth inequality in our history. That never ends well for any nation. But of course that's affecting the middle class, which is becoming more and more extinct every day. And of course, that also ties directly into social unrest and all the problems in this irreconcilable America, the divided states of America we can talk about. All of these things are tied together. But for the very, very wealthy, inflation, taxation, higher interest or higher debt costs or higher costs of borrowing, that certainly hurts. But for the middle class or the working poor, that's devastating.
As the global financial landscape continues to evolve, market sentiment towards silver is becoming increasingly bullish. Investors around the world are recognizing the unique value proposition that silver offers in this time of uncertainty and potential upheaval. The metal's dual role as both a precious metal and an industrial commodity makes it an attractive option for those looking to diversify their portfolios and hedge against the risks associated with traditional fiat currencies. In recent months, we have seen a significant uptick in interest in silver, driven by a combination of factors including economic instability, rising inflation, and the increasing likelihood of a shift away from the U.S. dollar as the world's reserve currency. This growing sentiment is reflected in the market trends, where silver prices have remained resilient despite fluctuations in other asset classes. One of the key drivers of this renewed interest in silver is its perceived undervaluation. Many analysts believe that silver is currently trading at a discount relative to its intrinsic value, especially when compared to gold. Historically, the gold-to-silver ratio has been a reliable indicator of silver's relative value, and by many measures, silver is currently undervalued. This presents a potential buying opportunity for investors who are looking to capitalize on the expected rise in silver prices as global economic conditions continue to deteriorate. Moreover, the industrial demand for silver adds another layer of support to its market. Unlike gold, which is primarily used as a store of value, silver has significant industrial applications, particularly in the fields of electronics, renewable energy, and medical technology. The ongoing global push towards green energy, including the increased production of solar panels and electric vehicles, is expected to drive up the demand for silver in the coming years. This industrial demand, coupled with silver's role as a hedge against financial instability, creates a strong foundation for sustained price growth. Institutional investors are also beginning to take notice. Large hedge funds and investment firms are increasing their exposure to silver, seeing it as a critical component of a diversified portfolio in a time of economic uncertainty. These moves are often a precursor to broader market trends, as retail investors tend to follow the lead of institutional players. The influx of institutional money into the silver market is likely to drive prices higher as demand outstrips supply in an already tight market. Furthermore, the rise of digital platforms and exchange-traded funds apps focused on silver has made it easier for everyday investors to gain exposure to the metal. This democratization of silver investing is leading to a broader base of market participants, which in turn supports higher prices. As more investors seek to protect their wealth in an increasingly volatile world, silver's appeal continues to grow. The question now is not whether silver will rise, but how high it can go. The combination of geopolitical tensions, economic instability, and rising industrial demand is creating a perfect storm for silver to potentially reach new highs in the near future. Investors are positioning themselves accordingly, increasing their allocations to silver in anticipation of these trends. In the final section, we will bring all these elements together to discuss how silver could become the ultimate hedge against a collapsing dollar and why it might be the best investment choice in the years to come. But for now, it's clear that market sentiment is increasingly in favor of silver, and those who recognize its potential early could stand to benefit significantly as these trends unfold.
Pete, with the CPI. If you own gold instead of dollars, you can still afford to do the things that your dollars was once able to do. And again, Egon has a story where Yugoslavia had hyperinflation in the 1990s. He was at a restaurant in Ticino in the Swiss Alps, or in the Alps in Europe, and a waiter said, "I recognize you, Egon. You're the man who got me to buy gold." So when Yugoslavia tanked, he started buying gold. He had gold instead of Yugoslavian currency. He was able to get out and open a restaurant in Europe because he measured his wealth, he stored his wealth in gold, and he spent in liquidity and paper money. And again, those are two anecdotes, but they're simple, stupid examples. No, gold will not make you a millionaire. But if you have a couple 100,000 or 100,000 or 10,000 and you want to protect its purchasing power, you have to allocate that to physical precious metals, because 10 years from now, 20 years from now, I don't know what the gold price will be, but I know one thing: that gold will buy more for you than the dollars you spend on it today. That gold stores its value more than dollars. And so to your question, what can anyone do, whether they're millionaires or whether they're barely getting by? You can still do your best. I know the premiums are going to be higher at retail levels or whatever, but you have certain services that are better. You can still put a little aside every month. If maybe you can't, but if you can, even the smallest amount, that you can start stacking your own gold to just ensure your own paper money or your salary or your returns. And I know we sound like we're just selling our book. Of course, we're selling our book. We're selling our bias, but it's a bias that's honest and it's conviction. And I welcome anyone. Certainly you can get more return on Bitcoin than gold, depending on when you pick and choose. And I'm not here to mock that, but there is a lot of risk there too. And do your own homework on that. But gold, I don't lose sleep on. Bitcoin, you could make you rich or it could make you a fool. We'd have to have a whole separate conversation about that. But I think gold throughout history has proven it gets the last laugh over broken regimes, broken currencies, and broken nations. And let's be honest, America is broke. It's not the end of America. It's not the end of the dollar. It's going to be repriced. Whoever wins in November is going to upset half the population. We have problems ahead. It's not going to be one smoldering ghost town, but let's not kid ourselves. We have a currency crisis. We have a debt crisis. We have a political crisis. We have a social crisis. Gold is breaking away from all correlations because gold is at least one very simple answer to this problem. And to your other question, 60-40 portfolios, be very careful. Even if they go up, which I don't think they will because I think they're correlated, even if they go up, you're still measuring a return in fiat money, which buys you less and less.
As we have explored throughout this discussion, silver is emerging as a critical asset in the face of growing global economic uncertainty. But beyond its historical resilience and current market dynamics, there is an even deeper reason why silver is capturing the attention of investors worldwide: the impending challenges to the U.S. dollar's dominance and the broader financial system. This situation presents not just a unique opportunity, but also a necessity for those seeking to protect and grow their wealth. Given the context of increasing geopolitical tensions, the gradual shift towards de-dollarization by major global players, and the Federal Reserve's precarious monetary policies, the financial landscape is shifting in ways that many are only beginning to understand. As traditional fiat currencies face mounting pressure from both inflation and loss of confidence, the role of hard assets like silver becomes ever more vital. But what does this mean for you as an investor? The market sentiment we discussed earlier is more than just a trend. It's a signal. Silver is being recognized as a necessary hedge not only against inflation, but also against the potential collapse of the very financial system that has been the backbone of global trade for decades. This growing interest in silver is not merely speculative. It is rooted in the fundamental realities of our time. As the global economy becomes more fragmented in the power dynamics shift, the U.S. dollar's hegemony is increasingly under threat. This is no longer just a theoretical debate among economists. It is a reality being shaped by the actions of nations and central banks around the world. The BRICS countries, with their push towards alternative currencies and financial systems, are at the forefront of this movement, and their actions are setting the stage for a new global economic order. In this context, silver's appeal is clear. It is not just a hedge against the volatility of paper currencies, but a strategic asset that could see substantial appreciation as the dollar's role diminishes. With its intrinsic value, critical industrial applications, and historical reliability, silver is positioned to thrive in a world where fiat currencies are increasingly questioned. As we approach the climax of this discussion, it's essential to consider how you could position yourself to benefit from these unfolding events. Are you prepared for the potential decline of the dollar? Have you considered the role silver could play in safeguarding your wealth against the looming uncertainties? The next few years could see significant changes in the global financial system, and silver is likely to be at the heart of these transformations. Whether as a hedge against inflation, a store of value during economic crises, or a key component in a diversified portfolio, silver offers opportunities that few other assets can match. So, what are your thoughts? Do you believe silver could become the ultimate safe haven in a world where the dollar's dominance is fading? How are you planning to navigate the potential financial storms ahead? Share your views in the comments below, and don't forget to subscribe for more insights as we continue to explore the implications of these historic shifts. And remember, while these discussions provide valuable perspectives, they are not financial advice. It's crucial to do your research and consult with financial experts before making any investment decisions. The future is uncertain, but with careful planning and strategic investments, you can protect and potentially grow your wealth, even in the most challenging of times.